Good day to everyone. I am Nicolas Bornozis of Capital Link, and I'd like to welcome you to our weekly Analyst podcasts. During this podcast, we have the opportunity to discuss with equity and market analysts and who share their views on current trends and developments in the market. And today I am delighted to have with us Ben Nolan, who is the head of maritime research at Stifel. Just as a reminder that these podcasts are done simply for informational and educational purposes, and they do not constitute any investment advice or advice of any kind. And with this, I will welcome Ben. Ben, thank you for being with us.
Well, thank you for having me, Nicholas.
So let's talk about the market a little bit. Let's start with the port strike. What happened? Where are we? What's the impact?
Well, I think what this has proven is that it's really hard to predict what's going to happen with a port strike. Obviously, it lasted 3 days. Our view is that it could last maybe a few weeks before the government got involved, potentially ahead of an election. And maybe that's still what happened. Maybe there was some pressure to side with labor, but at the same time not disrupt the economy. And so effectively they postponed everything until January, because what they haven't done yet is address some of the automation issues. They were able to agree on wage increases, pretty substantial wage increases, which must be nice. But the automation is really the big sticking point. The U.S. really lags the rest of the world in terms of port automation. And it is, frankly, because of organized labor, and they were unable to come to an agreement as to sort of what is the appropriate level of automation going forward. So there is a distinct possibility that we could be having a similar conversation in just a few months. But at least it's in the rearview mirror for the time being. I think 3 days had a inconsequential impact on the economy, had an inconsequential impact on shipping, other than there was probably some front running of trade ahead of people trying to get ahead of a potential disruption and moving things to the West Coast, but ultimately not too impactful on much of anything, frankly.
So the conclusion is, from what you're saying, that it's not over yet. It's a topic that we may see in front of us again in the near future.
I'd be surprised if we did not. Yeah.
So now let's move to deep sea shipping. Let's talk about the various sectors, starting now with the tankers.
Mm-hmm.
Tankers have been benefiting from the Middle East tensions. Also, we are coming closer to the winter months, which traditionally have been a very good period for very good time for tankers. What is your take on the sector outlook?
Yeah, I think we're viewing this year in terms of tanker rates being similar to what we saw last year, an uplift in the fourth quarter. We've already begun to see that a little bit off of a sort of the weak end of September, but not necessarily one of the super peak seasonal periods that we have seen in other occasions, where VLCC rates can get to whatever $200,000 a day, or just big numbers. Clearly, we are continuing to be, or the market continues to be helped by the Middle East tensions and ships going around Africa, as well as the continued impact of Russian cargoes having to divert from Europe and going longer distances. And thankfully, the Panama Canal is no longer as much of an issue. But at the end of the day, oil demand is the bigger sticking point a little bit. It's not bad, and clearly oil prices remain above $70 a barrel. But nor at this point, nor does it look like we're going to see a meaningful seasonal uptick in oil demand, which we sometimes do. And so as a function of that, again, we're assuming a little bit better market. Shipping efficiency tends to break down when the weather gets worse. and that tends to help the rates. And I think that is how we're expecting the fourth quarter and to a certain extent the first quarter to play out this year.
Thank you. Let's move now to containers. With the holiday season approaching, there has been traditionally more demand for cargo traffic. On the other hand, again, we have the Middle East tensions, the port strike in the US. What does this mean for the sector?
Yeah, there's a lot happening, as you said, in the container market at the moment. This has been a remarkably good year following what was not a very good year last year, and there are probably the largest single impact there is the Red Sea effective closure, and that may have added 8 to 10% to or effectively shrunk supply by 8 to 10%. Caused box rates to substantially more than double. And there has been a few little waves in terms of the rates. They're coming down at the moment. They have been coming down for a couple months now, I guess. Still at pretty good levels, but certainly off of the recent peaks. And I think the reason that you're seeing that is the market. It took a little time to absorb a few of these factors, these idiosyncratic factors. First, all the ships having to go around the Red Sea, or go around Africa rather than the Red Sea, which almost all container shipping is doing. And then, as I mentioned earlier, there certainly was some shifting of freight and volumes ahead of a potential East Coast and Gulf Coast port strike. And so now those are kind of adjusted for. It depends on who you talk to, and we have talked to a lot of people as to whether or not there was inventory building in the U.S. ahead of the potential disruptions, but unquestionably volumes were substantially higher, particularly on the West Coast. And so I think to the extent that there was at least some inventory building, now is the point where you begin to draw down on those inventories. And that, I think, is what you're seeing reflected in some of the box rates. As the box rates go lower, you're going to see less pressure by the liner companies to charter vessels. And so we're probably, again, this has been a really good year. I expect third quarter to be really good for all the liner companies, but probably the peak. And from here, it likely stays better than it was last year, simply because the Red Sea issues haven't been resolved. But you begin to fade for a little while.
Thank you. Let's move on now to dry bulk. We see that there have been some concerns about Chinese demand. On the other hand, traditionally, the first quarter of the year is a softer period for dry bulk. So what is your outlook on the sector let's say in the shorter term, medium term, and what else can be a driver besides China?
Well, I mean, dry bulk is, we sort of feel okay. It hasn't been a bad year, hasn't been a phenomenal year. Feels relatively balanced with respect to supply and demand. Dry bulk is less impacted by the geopolitical tensions and, ships going around Africa and so forth. China is still the biggest factor, but I think one of the things that we feel a little bit more comfortable about is in recent weeks and even coming into this weekend, the Chinese have shown that they're willing to take steps to stimulate their economy. Really, things like their coal imports and other things have been relatively solid this year. It hasn't been bad. You do have iron ore inventories that are a little on the high side, but they've kind of plateaued at that level. I think seasonally, I agree. I think as you go into the first quarter, you normally do see them draw down on their inventories a little bit, just be a little bit less active around the Lunar New Year. And that's sort of how we see it playing. I think we'll have 4Q in our view is going to be a little bit better than 3Q, but not a lot. And in general, the market is seasonal but well balanced. As we go into next year, there are a few pretty substantial new developments. A big iron ore mine in West Africa that's coming online that should certainly increase ton miles for your Capesize and Newcastle-Max ships. We'll have to see how the grain world plays out, but to the extent that the Chinese are continuing to looking to support their economy and not just sort of let it go, we're not overly pessimistic with respect to dry bulk. I think it's hard to feel like it's on the cusp of a monumental rise, just because the economy is doesn't feel like it's on the cusp of a monumental rise, but it doesn't feel bad. And I think certainly we continue to take comfort in the fact that the order book for dry bulk, certainly relative to really almost all of the other categories of shipping, remains relatively benign. And so, not to say that everything else is bad, but it's the lowest. And so you're probably the best supply side dynamics in dry bulk.
Thank you. So also exactly, you pointed out the supply side dynamics, which are quite favorable here as well.
Yeah.
Let's conclude with the gas sector, LNG, LPG.
Yeah.
What's your take on that?
So I think to the extent that oil prices remain high, that it is somewhat helpful to both of those categories, because natural gas and LPG there is a degree of substitutability. And so if oil is high, then there's less demand to substitute. It varies. I think on the LPG side, really what you're talking about is the effect of arbitrage to move things like propane from the United States elsewhere, relative to naphtha prices. For LNG, that side, it's a little bit more a function of how many new cargoes are going to be available to the market. And that, while growing substantially, and we do expect a number of big new projects to come online in the near term, there have been a few delays. And so I think the LNG market has been soft, not terrible, but soft. And it might stay there. We haven't yet seen a big seasonal uplift in terms of storage. So again, we're at this point, and frankly, European natural gas inventories are relatively high compared to where they would normally be. So there's not as much of a demand for floating storage. The market is okay, but there's a lot of supply, and the number of new cargoes is coming, but a little bit behind schedule relative to the ships. On the LPG side, and really, frankly, a little bit on both sides, one of the things that does worry us a little bit is supply. You have a lot of ships that are on order, and there will be more cargoes, but as we've seen in the past, there can be mismatches in timing between when the ships are delivered, which is usually on time, and when the cargo is delivered, which oftentimes is a little bit late.
Thank you. Ben, there has been an increasing environmental regulations have becoming stricter, a lot more mobility now at the IMO level. Fuel EU is around the corner. So how do you expect that with these coming online, that there will be more slowdown of the global fleet, and what could be the impact on fleet supply and thus on freight rates?
I think the answer, I guess, is yes, with an asterisk. I think that I'm not expecting it to be a massive fleet-wide slowdown. I think modern ships, and much of the fleet is modern and efficient. are already pretty well suited and unlikely to have to slow down. I think when you start to talk about vessels, and this isn't universal, but generally maybe things that are more than 15 years, certainly more than 20 years, were just not built to be as efficient as the newer equipment, and as a function of that, have greater emissions. And the way that those assets solve their emission issues is going slower. So I think we could be in a world where the gap between new and old expands further in terms of asset utilization, in terms of ship speed, which in turn translates into profitability of the assets. I'm not a believer in the idea that that is going to result in massive reduction of fleet size or big scrapping in the absence of a weak market. I think in a strong market, history has shown people can find a way to keep things in the water, and the environmental regulations are relative to the elimination, say, of single hull tankers. It's less a line in the sand, and there are more workarounds. So I think we will get to a point for things like dry bulk and tankers where there will be large scale removal of older equipment. But in my view, that coincides with weak markets.
You made a very interesting point that we've heard that point being also raised by a number of shipping companies that do fleet renewal, that we may end up having a two-tier market where the younger, more fuel efficient ships are not going to be impacted, but the older tonnage needs to be either overhauled or may be impacted negatively in terms of tradability.
Right.
So that's quite an interesting point.
Yeah.
Now, let me conclude by asking you, I just came back from Athens. I was attending the fifth triennial gathering of the various business school, the Gramenos Center for Shipping, Trade and Finance, an amazing lineup of industry leaders, and it's a testament to what Costa Gramenos has created, educating the leaders of the industry. So all over the world. So one of the main topics there was on capital markets, very positive developments on the bond side. We've seen a flurry of activity, more interest from the part of issuers. But when it comes to the equity markets, there was not as much optimism in terms of new IPOs or additional equity raises. What is your take on this?
Yeah. And first, let me just say that you've done pretty well yourself in helping to educate everyone on the maritime space. So
Thank you.
I would definitely put you in the same category.
I cannot be compared to Professor Gramenos, who has done an amazing job, but thank you for the for being so kind.
I think the challenge remains with respect to shipping equities, that, and this has been the case for a number of years, that public equity investors remain pretty anchored to NAV, and the vast majority of public shipping companies, particularly in areas that are a bit more commoditized, like tankers and dry bulk, the majority of those companies trade below NAV, and that means that for new entrants in a commoditized market, really the competitive advantage is being willing to accept a lower cost of capital. And when, let's say the dry bulk industry at the moment, you probably have the priced NAVs for the sector in, 70%, 75% of NAV is where the equities are trading. That means for a new entrant, they have to be lower than that. And it is unless somehow or another they're able to sort of rewrite the script and create a narrative that means that they're different somehow or another, which is hard to do. Then it's just very expensive capital is the answer. The public equities for shipping have not been cheap for a few decades now, really, or at least a decade and a half. And I think also in a world where cash flows are pretty good, there is less of a need for outside capital as well. And so it's again, I think it really boils down to cost of capital, and it remains expensive.
Thank you for hitting one of a very interesting topic, the issue of valuation, how the public shipping companies are appreciated by the market. This is a big topic, and one of the things that I would like to do is host a podcast, a webinar with you and a couple of other analysts to debate the topic. But I'd like to share my viewpoint that it really makes no sense to see that shipping companies that have invested millions and millions into building commercial networks, computer networks, infrastructure, management systems, educate their seafarers and personnel, that all of these investments are not valued properly by the market. Actually, that sometimes you see that they are valued at below steel value, breakup value. So at the same time, shipping is a vital link in the global economy. 90% of global commerce is carried on ships, and therefore shipping is not just an exotic, seasonal, volatile sector. Shipping is a very steady function in the global supply chain. Somebody said, I forget who, that if shipping ever goes on strike, half of the world would freeze and the other half would starve, because shipping delivers everything that we need in our livelihood, energy, commodities, finished goods, and so on. So I think it would be a very interesting topic debate to have, and thank you for concluding our podcast with this. These podcasts are supposed to be short, so I will end it here. I'd like to thank Ben, great analyst. Thank you for your cooperation over the years. Thank you for being with us today.
All right, and thank you, Nicolas.